The rise of the stock market as a mechanism for funding industrial empires is one of the most transformative developments in economic history. A shift that redefined how societies allocate capital, how innovations scale, and how entire nations mobilize financial resources to build infrastructures, factories, railways, and technologies that reshape the world. To understand this rise, one must look back to the late 17th and early 18th centuries, when the concept of joint stock companies enterprises, financed by multiple investors pooling money into a common fund, began to evolve from isolated experiments into a full-fledged system capable of fueling industrial expansion. Before stock markets, economic growth depended on personal fortunes, royal charters, and private partnerships limited by the wealth of a few individuals. Ambitious projects such as canals, mines, shipping fleets, or machinery were constrained by scarcity of capital and high personal risk. The stock market changed that by transforming ownership into tradable shares, lowering the barrier to investment, spreading risk, and enabling entrepreneurs to tap into vast reservoirs of public capital. The earliest precursors of this system emerged in Amsterdam, where the Dutch East India Company became the first widely traded joint stock corporation, demonstrating how shared financial risk could support global-scale ventures. But the true revolution came later, during the Industrial Revolution in Britain, when the explosion of technological innovation from steam engines to mechanized textile mills created unprecedented demand for large-scale investment. Factories required machines, machines required coal, coal required transport, and transport required massive networks of canals and later railroads. No single merchant or family could finance such undertakings alone. The stock market became the bridge between private ambition and public capital, allowing thousands of investors from aristocrats to shopkeepers to contribute funds and share in the profits of industrial growth. This democratization of investment created a feedback loop. The more companies raised capital, the more industry expanded. The more industry expanded, the more profits flowed back to investors. And the more investors saw returns, the more they were willing to reinvest in new enterprises. Britain's industrial ascent was inseparable from this financial innovation. Stock exchanges in London, Liverpool, Manchester, and other cities became bustling centers of speculation and opportunity. But it was not only Britain. The idea spread rapidly across Europe and North America. In the United States, the rise of the New York Stock Exchange paralleled the country's transformation from a young republic into an industrial powerhouse. Railroads, in particular, became the backbone of American industrialization, and their massive capital needs turned the stock market into a national institution. The scale of railroad financing was unprecedented. Companies issued bonds and shares to thousands of investors, enabling them to lay tracks across vast distances, connect cities, transport goods, and unlock natural resources that had previously been inaccessible. The stock market became a primary engine of territorial expansion, economic integration, and industrial growth. This connection between stock markets and industrial empires reveals a deeper truth. Modern capitalism is built on the flow of capital into risky ventures, whose success depends on scale. Without the stock market, factories would have remained small, railroads would have expanded slowly, and technological innovation would have been constrained by the limits of private wealth. Investors, in turn, embraced the idea that risk could be shared, traded, diversified, and managed through a marketplace that valued companies not only for what they were, but for what they could become. This speculative dimension of stock markets played a crucial role in industrial development. Investors bet on ideas, technologies, and futures. Some bets failed spectacularly. Others altered the world. The Industrial Revolution was therefore both a technological and financial phenomenon. Innovations such as the spinning jenny, steam locomotive, and telegraph were inseparable from innovations in finance, stock exchanges, investment banks, underwriting systems, transferable shares, and limited liability laws. Limited liability, in particular, was a breakthrough. It protected shareholders from personal ruin if a company failed, encouraging broader participation in high-risk ventures. Governments recognized the power of this system and enacted laws to regulate and expand it, balancing the dangers of speculation with the benefits of economic growth. But the rise of the stock market was not without turbulence. The same mechanisms that fueled growth also fueled bubbles, manias, and crashes. The South Sea Bubble in Britain, the Canal Mania of the early 19th century, the American Railroad Bubbles, and later the 1929 Wall Street crash, all demonstrated the double-edged nature of shared investment. Yet each crisis also contributed to the evolution of regulatory systems, accounting standards, and financial oversight that strengthened the long-term resilience of stock markets. In this sense, the stock market matured much like industrial society itself, through cycles of ambition, excess, collapse, and reform. As industrial empires expanded, the stock market became more than a financial tool. It became a cultural force. Newspapers printed stock prices daily. Middle-class households discussed investments at dinner. Policymakers monitored markets as indicators of national strength. Entrepreneurs learned that raising capital was as important as building machines. The stock market created a new class of professionals: brokers, analysts, auditors, bankers, and promoters, all contributing to a financial ecosystem that enabled industry to grow at unprecedented speed. The idea of the corporation evolved from small partnerships into colossal industrial enterprises, employing thousands, dominating regions, and shaping political decisions. The globalization of stock markets further accelerated industrialization. Capital from London financed railways in India, mines in South Africa, telegraph lines in the Americas, and shipping routes across the Pacific. The interconnectedness of markets meant that industrial empires were no longer confined to national borders. They became multinational entities whose influence extended from finance to geopolitics. The stock market thus helped fuel not only industrial growth, but colonial expansion, resource extraction, and the integration or exploitation of global economies. By the early 20th century, the stock market had become a cornerstone of modern economic life. The titans of industry, Carnegie in steel, Rockefeller in oil, Vanderbilt in railroads, Morgan in finance, built vast empires funded directly or indirectly through public markets. Their enterprises employed millions, shaped cities, and transformed daily life. And yet the true power of the stock market lay not in these giants alone, but in the millions of ordinary investors who collectively fueled the rise of industrial capitalism. Every share purchased, every bond issued, every dividend paid represented a vote of confidence in the continuous expansion of industry. Ultimately, the rise of the stock market created a world in which economic growth was no longer limited by the wealth of individuals, but by the imagination of societies. It harnessed collective capital to build collective futures, bridging the gap between invention and implementation. It turned ideas into factories, factories into industries, and industries into empires. And as industrial capitalism matured, the stock market became a mirror of human ambition, reflecting our hopes, our fears, our desire for progress, and our willingness to take risks in pursuit of a better future, all of which converged into a system that continues to define modern economic life, showing how finance and innovation evolved not as separate forces, but as intertwined engines driving civilization toward new frontiers, expanding the scale of what humanity could build, coordinate, and dream, until eventually the modern world emerged from that fusion of capital and industry, standing as a testament to the extraordinary power of capital when it is organized, democratized, and directed toward large-scale human ambition. In the second phase of this story, after the stock market helped ignite and accelerate the Industrial Revolution, its role deepened not merely as a funding mechanism, but as the central nervous system of modern capitalism, shaping corporate behavior, national policy, global competition, and the very rhythm of economic life. As industries expanded across continents, the stock market evolved from a marketplace for shares into an ecosystem of expectations, signals, and incentives that influenced how companies operated and how entire economies developed. Corporations learned that their ability to raise funds depended on public confidence, and so transparency, accounting systems, and standardized reporting gradually became essential. Investors demanded clearer information. Regulators began imposing rules. The stock market, once a chaotic arena of speculation, matured into a structured institution that rewarded discipline as much as daring. In this environment, industrial empires discovered that financial strategy could be as important as industrial strategy. Companies used stock offerings not only to raise money, but to acquire competitors, build monopolies, and consolidate entire sectors. Railroads merged, steel companies fused, oil trusts formed, and national champions emerged, entities so large and interconnected that they shaped labor markets, influenced governments, and controlled critical infrastructure. The stock market became the battleground, where these consolidations were fueled, financed, and justified. It was also the arena where fortunes were made and lost, where middle-class investors learned to navigate cycles of boom and bust, and where nations measured their economic vitality through market indexes that captured the pulse of collective optimism or fear. The stock market also became a powerful cultural force. Newspapers published daily price tables. Coffee houses and brokers' offices buzzed with rumors, analysis, and ambition. Ordinary citizens began to invest, seeing the market not as an elite playground but as a gateway to participation in national growth. This broadened investor base created a new social contract. Corporations were accountable not just to wealthy founders or aristocrats, but to thousands of citizens whose savings were tied to the nation's industrial destiny. The rise of pension funds, insurance companies, and mutual funds further widened this connection, turning the market into a repository for the long-term hopes of millions. Globally, the spread of stock markets intertwined the destinies of nations. London financed far-flung projects that integrated the British Empire. Paris funneled capital into railroads and canals across Europe and North Africa. New York fueled the explosive growth of American manufacturing and infrastructure. As telegraphs, then telephones, and later radio-connected global markets, information traveled faster, linking economies in real time. A crisis in one country could ripple instantly across oceans. A boom in another could attract foreign capital and spark new industrial expansion. The stock market became the circulatory system of globalization, distributing capital to where it was most demanded and sometimes withdrawing it abruptly when panic struck. These new interdependencies made regulation essential. Governments introduced securities laws, anti-fraud measures, listing requirements, and central banks to stabilize financial systems. The Great Depression of 1929, triggered in part by unchecked speculation and financial leverage, forced countries to rethink the delicate balance between free markets and oversight. The reforms that followed, such as the creation of the U.S. Securities and Exchange Commission, laid the groundwork for the modern regulatory state. These systems did not eliminate volatility, but they mitigated its most destructive effects, allowing markets to support industrial growth without repeatedly collapsing under their own excess. As the 20th century progressed, the relationship between the stock market and industrial empires grew even more intricate. The post-World War II boom saw massive corporate expansion funded by public markets. Automobiles, chemicals, consumer electronics, and aerospace industries surged, nurtured by both government contracts and investor capital. Meanwhile, the invention of index funds, quantitative analysis, electronic trading, and global exchanges transformed the speed and scale of financial transactions. By the late 20th century, the stock market no longer merely reflected industrial growth. It anticipated, it shaped it, and sometimes distorted it. Companies optimized earnings to please investors. Managers obsessed over quarterly results. Hedge funds and institutional traders introduced new incentives and pressures. Yet, despite these tensions, the fundamental role of the stock market as the fuel for ambition remained unchanged. The stock market also democratized opportunity across borders. Emerging economies like Japan, South Korea, and later China leveraged public markets to finance rapid industrialization. Markets in Hong Kong, Singapore, Bombay, Sao Paulo, and Johannesburg became engines of regional growth, channeling capital into infrastructure, manufacturing, technology, and consumer industries. The rise of multinational corporations blurred the boundaries between nations, making the stock market a global arena of capital allocation, where investment could flow to any company, anywhere, that promised returns. By the dawn of the 21st century, a new phase began: the shift from industrial empires to digital empires. Tech companies, fueled by IPOs and venture-backed exits, used public markets to scale at unprecedented speed. Amazon, Google, Apple, Meta, and countless others built platforms that reshaped communication, commerce, entertainment, and human behavior. Their growth demonstrated the stock market's ability to fund not only physical infrastructure but digital ecosystems reaching billions of people. As intangible assets, data, software, algorithms became more valuable than factories or railroads, the stock market adapted once again, evaluating companies not by tangible output but by network effects, user growth, and future potential. The logic of speculation, once applied to tulips and railroads, now applied to the architecture of the digital age. In the end, the story of how the stock market funded industrial empires is also the story of how societies learned to collectivize risk, trust in future growth, and pool resources on a massive scale. It is a story of ambition and caution, innovation and excess, expansion and crisis, hope and fear. The stock market is not merely a financial institution, but a reflection of humanity's deepest impulses: to build, to dream, to speculate, to compete, to collaborate, and to imagine futures that do not yet exist. Through its mechanisms, industrial empires rose, global networks formed, and modern economies emerged. And despite its volatility, its complexity, and its imperfections, the stock market remains one of the most powerful inventions in history, a machine that converts collective belief into industrial reality, transforming visions into enterprises, and enterprises into engines of civilization. Completed.